Good afternoon, everyone. Actually, good evening. Getting close to sunset here. Hopefully everybody for the fathers out there, hopefully you had a nice Father's Day weekend. I had a great weekend. Kids came over. We were able to watch a movie together, and they gave me this nifty microphone and this gyroscopic phone holder thing. So now I'm able to walk around and have good steady videos, and you can hear me better. A lot of folks were complaining were telling me that they couldn't hear my voice too well with the regular mic. So hopefully this comes out loud and clear. Find out in a second. I wanted to put a video together, it's probably gonna be a 3-part series because it's a lot to cover. It mostly deals with finances and personal investment. I've been reading up on personal investment, figuring out where to put my money ever since I was in my early 20s. And it was mainly because my friend, who was really savvy, really nice guy, helped me through flight school and everything, was a Navy pilot. And he basically suggested I read Wealth Without Risk, and also just to learn about the different places I could put my money, how it could accumulate, just be financially savvy, because I had no clue back then. I mean, back then in my mind I was just thinking about getting a job and earning money. I mean, and then saving some money, I guess. And that wasn't even a big priority. It was just, hey, make money and get rich. I mean, that was very general. And so, I mean, that doesn't get you anywhere, right? I mean, if you don't know what you're doing. So started reading Wealth Without Risk. And then I found the Wall Street Guide to Personal Finances. Read that. That was really easy to read. They still have that in print. Both books are actually in print. And I really want to thank my friend John. He passed away from a training mishap. And, in the Navy, you just realize how risky things are out there. We train like we fight, and we have a lot of mishaps during training because we're doing the stuff that we would be doing in a time of conflict. And it's like a brother of mine helped me out, and I just want to thank him. He's gone now, passed away too early, too young, in his 20s. But John, thanks, buddy. And all the stuff you taught me helped me and my family. I'm just passing on this knowledge to help others. Hopefully others could benefit, and I know others would benefit. So with the personal finance, basically, there's a lot of terms. There's a lot of stuff to know. I thought it was easy because I've been reading about it, and the stuff has been compounding. It's been stuff that I've thought about and practiced, and it's put me in a good spot. And so I wanted to pass this information out to my kids, my family, but even talking to them for a while, it's really complicated. I thought it was, I'm thinking it's easy because I just know it. And it's been, I've been taking years to read about it and to keep up with stuff. But, this is stuff that is not as simple if you just blurt it out. It's like, if you're on the other end listening, it's like taking it in, drinking out of a fire hose. But the foundations are there. I mean, it's not really difficult. It's just a lot of stuff. But I think if we break it down into nice sizable chunks and explain it well, I think anyone can get it. And that's why I'm putting this video together. These videos, it's going to be more than one. The first part is going to be definitions, and I think that'll lay the foundations down. I'm going to start basic, like very basic, as in we're going to talk about graphs, we're going to talk about how things are plotted, we'll talk about all the different vehicles, what aggressive is, what conservative is, what mutual funds are. I mean, I'll go over all these definitions, just straight up definitions, so we could build that foundation. And you could, replay and review if you want. But I'm not a CFP, I'm not a certified financial planner, but I've done pretty well without a certified financial planner, just because of the reading and stuff. I did put a lot of time into it. And even though I'm not a CFP, I don't feel I'm misleading you guys, mainly because, I mean, this is the way I think about it is, you know, I'm not a PhD in mathematics. I'm not a doctor. I don't have a doctorate in mathematics. However, if I wanted to teach you the basics of addition, subtraction, multiplication, division, you know, all the stuff you need on a daily, or 80, 90, you know, 80, 90, 99% of the stuff a regular person needs on a daily basis, I could teach that. I just as well as any mathematician PhD, right? I mean, I could teach how to add, subtract, figure out how to multiply, figure out how to find the square footage of your house so you know how much wood packages to buy if you want to put wood flooring down, you know, just stuff like that, right? I mean, stuff is fundamental. A lot of the stuff that you need is fundamental, and it could be explained well for someone who's done it. Another example I think about is like word processors and Excel spreadsheets and all that stuff. You know, if you look at the user guide for those things, I mean, the books are like this thick. But to use Microsoft Word, the majority of what you use, you can probably cover in like 1 or 2 pages. Or I could even explain how to use Microsoft Word, how to get a word processor in there and type out a document and save it. You know, file, save, delete, edit. You don't have to read that whole book and be a master on that software, right? So it's the same thing with finances. I mean, there's nothing to fear. We can go over it. I'll go over the definitions. By the time we're done with this video, you're gonna have a solid foundation of what, you know, 90, 95%, what the main things you would need. I'm not gonna go into shorts and turn you into like a day trader where you become a millionaire trading stocks and being this master of Wall Street or anything like that. The goal is to basically get these definitions down so that you could come out with a simple savings plan, which everybody would benefit from, right? Figure out the savings that you, come out with a good savings plan, and the money that you get, you'd be able to put into the right places that'll let it grow. Not just putting it in a piggy bank or putting it in some bank account or savings checking account, which is fine in some cases, but you got to know about the other places to put your money in. And if you do that, you'll find that you can, it doesn't take an extraordinary effort to build wealth, to be able to make your money multiply. It'll multiply little by little, but then eventually it's gonna pick up some momentum, and you're gonna see that through time is your key here. You'll be able to generate and increase the savings that you have, much more than if you just stuck it in your mattress or put it in a piggy bank somewhere. So that's what I'll do. The first part is gonna be definitions, strictly definitions, so you have an idea of the tools you're working with. The next video after that is gonna talk about perspectives, like what I think, what I did, and you'll be able to go in there and make up your own mind and decisions and figure out what risks you want to take, how aggressive you want to be. We're going to start with the basic building blocks of investing, and which is a share. And so for now on, when you invest, you want to think of buying shares. Don't think about putting $1,000 in something. You know, don't think of dollar amounts anymore. Think of how many shares do you own. Of course, shares translates to dollars depending on their worth. But right now, we're going to focus on shares. That's the building block of investments. So, like I said, we're going to go from the bottom up here. We're going to start with the very basic and catch everybody up. And I apologize, you know, if some of this stuff you already know, but yeah, I think it's best that we just start from the ground up. And that way we speak the same language as we go into the other videos of strategies and thoughts, different perspectives. So starting off with shares, let's look at this blue circle as as one whole pie. Like just ignore the green writing for right now, the stocks and the mutual funds. We're just going to think of this as an object, as a apple or strawberry pie. And a share is just that. A share is a portion. So you would buy a share of this pie, right? So let's say somebody owns this pie, like some company, it's owned by somebody or something, some entity, and they decide to sell shares of it. So like they break it up in pieces, right? In shares. So this is exactly how it works. It's just simplifying it. So let's say it breaks it up into 8 shares of this pie, and you decide to buy this piece. So now you owe 1 share. You owe 1 share of the whole. So 1 share of the pie. And if the pie is worth, I'm just going to make it up here. If the pie is worth $80, just basic math, and you bought 1/8 of it, your share, they're probably going to charge you $10 for the share. I mean, they could charge tax and all this other stuff, but let's just say, just round it off. So you bought this share for $10. You own 1 share, and you paid $10. And that's how much it's worth the time you bought it, right? So let's say this pie is like a magical pie. It doesn't get rotten. Let's say the following week, the pie is now selling, or it's worth, it doubled in price. It's worth $160. It went from 80 to 160. So you're lucky because the share that you own, somebody wants to buy your share or is offering it or whatever. But now 160 divided by 8 is $20, right? It's 20. So this share that you bought for $10 is now worth $20. You still have just 1 share, but the value of it is $20. So that's it. Your shares didn't increase. It's 1 share, but the value of it increased. So if you sell it for $20 and you made a profit, you basically doubled your money. So that's all it is. You buy shares, you hold on to them. You could keep buying more shares and hold on to them. And then when you sell them, you sell them for the price and you could make money. Or on the flip side, you could also lose money, right? Because let's say the pie initially was worth, what did I say, $80? But now another company comes in and starts making a lot of pies. So now there's a lot of pies in the market. And now they're only selling them for $40 a pie. So 40 divided by 8, right? 40 divided by 8 is $5. So now this share here is only worth $5. So you paid 10. And if you sell it this time, you paid $10. You don't have that money anymore. But if you sell it, you're only going to get $5 back. So you sold it at a loss. So that's how you lose money. If your share value goes down and you sell, that's the important thing. You got to sell, then you lose money. If you don't sell, then yeah, it's worth $5, but you didn't really lose money. It's just kind of worth $5 and you didn't lose money. On paper, it looks like you lost money, but you still own the 1 share, right? And then who knows, maybe another week after that, the value goes up and then your share is worth more. So that's what I'm saying. You hold on to your shares, the value goes up and down. Sometimes the values don't go up, sometimes the values don't go down. It all depends on the companies and how volatile they are. So that's shares in a nutshell. So now let's take it up a step further. Of course, you're not buying pies. You're buying stocks. So buying stock is like buying a share. So stocks and shares are the same thing. If you buy a stock in a company, you're buying a share of that company. So if you go to Apple and you buy some of their stocks, you're buying some of their shares. And it's the same thing. If Apple is represented by this blue circle, Apple has a ton of shares they're selling. Sorry about the bad art here. But like there's 1 million of these and you buy like a little piece of Apple and it might cost you I don't know, whatever the cost of Apple is today. Let's say it's $500 a share. So you got to pay $500 to get one little share of Apple out of all the shares, all the possible shares. You could buy 5 or 6 shares and get a little bit bigger. You know, you buy 5 or 6 of them. You own a little bit more. But that's how it is. You just buy shares for a set price for whatever it's trading that day. And same is true with Boeing, Coca-Cola, any company that sells shares, that sells pieces of their company. You're just buying the pieces of the company. And that's what a share is. Plain and simple, that's what a share is. You could focus on a company and buy shares of a company, or you could buy mutual funds. And mutual funds invest in companies or in different entities, and they mix it all together and they sell their shares. So a mutual fund, so in this case, let's just say Vanguard 500. Vanguard is these financial firms here, Vanguard, Fidelity, T. Rowe Price, Schwab. They're all financial firms, and they sell mutual funds. And these mutual funds, like Vanguard 500, is one mutual fund in the Vanguard family. And Vanguard 500 invests in 500 different companies. So if you buy a share of Vanguard 500 mutual fund, you're buying a share of that big piece that invests in 500 different companies. So it's a mix. It's a group. You're not just, when you're buying a mutual fund, you're not just putting your money on one company. You're putting your money in a group of companies. And you could say the same with Fidelity, with T. Rowe Price. Just go down this list. Schwab, just go down this list. They have many mutual funds. The cool thing about nowadays, it's easy. In the old days, if you wanted to buy stock in a company, or if you wanted to buy some shares of mutual funds, then you have to go through like a broker, a stockbroker, and then pay him or her some salary, and they take a little bit of a commission. It was kind of complicated. But nowadays, the cool thing is you could go in and you could open up an account. It's like opening up a bank account, but you could go online, open up an account in any of these firms, T. Rowe Price, Fidelity, Schwab, Vanguard. There's an American Century. There's a bunch of them. You could open up an account, and when you open up an account, you could buy their mutual funds. Or the cool thing is, if you open up like one of these accounts, they sell directly to you any company stock. So if you want to buy Apple stock, you could do it through your Fidelity account, right? You open a Fidelity account, you could buy Apple stocks directly. You don't have to buy a mutual fund. You could buy direct Apple stock, or you could buy direct SpaceX stock if you want, or McDonald's stock. So it's very easy now. And then it's cool because you have an online account. You could see how much your shares are worth. I don't recommend like checking every day, but it's there. It talks about what your shares are worth. And because of the number of shares you bought, it'll tell you the whole worth, the value of all the shares you own. So that's all it is. Plain and simple. Shares. And you buy these shares, you can buy company or mutual fund stocks. That's all it is. All right. See, it's not complicated already to begin with. So as far as investing, again, think of buying shares, right? Think of buying shares. So when you invest, you could go from the conservative end here, or you could be aggressive. Now, it's all about how risky and how big of a swing you want to take. Now, if you go low risk, low reward, low risk means your money's safe. You know, things can happen. You know, the economy could drop. You got .com bubble. All this stuff can happen, and we'll cover that on the second video. But all this stuff can happen, but your money isn't gonna devalue. So if you go to work and you earn $50 for the day, and you stick that $50 in your mattress or your piggy bank, well, as long as your house doesn't burn down or something weird like that happens, then your $50 is gonna just stay there. It's not gonna grow. It'll be $50. Your $50 bill will stay $50 for 100 years, for however long it takes. It's not going to go up. It's not going to go down. $50 is $50, right? So if you just keep on saving that way, every time you make a paycheck and you stick it in your mattress, your piggy bank, your money is safe as it can be. That's what conservative means. It's pretty safe, but you're not getting rewarded. It's not growing, unfortunately, right? That's the price you pay for safety. Now, you could get a little bit riskier and put it in a bank. So now you put your $50 in a bank. So the bank is safer, but not as safe as a mattress or your piggy bank, because a bank can go bankrupt, right? A bank can go out of business. It doesn't happen very often, so it's still pretty safe. But since there is a little tiny bit more risk there, it's saying, hey, put your money, the banks are saying, put your money in our accounts and we'll give you, I don't know, 0.5% interest or some pretty low amount, but it's still better than zero as you get in a piggy bank. So that's why, that's what you'll get. On a CD, it's a little bit riskier, but the CD says, okay, put your money here for 6 months or one year or whatever, and we're going to give you 3% interest. Your money will grow by 3%. So again, it's pretty safe. Unfortunately, your money is stuck there. You can't just take it out anymore, but it's there, and it's going to grow 3% after 6 months or whatever the percentage it has, and then you get it. So these are safe. These are conservative accounts, but you can see the numbers are pretty low. You're not making a lot of money, right? Bonds are government backed. They're based on governments, so they're pretty safe. And unless a government collapses, unless the U.S. government collapses or the California government collapses, if you stick your money in bonds from government, it's pretty safe. I mean, maybe you'll earn 4%, 5%, who knows, something like that. So riskier than what you see here, but still fairly safe. It's still conservative, so you get a little bit more. It's still conservative, so you get a little bit of interest. Then you have the stocks, and depending on what company you pick, Apple, if you bought Apple stock way back when, I mean, your money could have like quadrupled. You could have went 1,000%. It all depends, right? But if you pick a bad company, like the company I picked, where they were trying to find a cure for some liver disease, and they didn't find the cure, well, the company went bankrupt, and I lost my money. I lost all my stock. It went to zero, it went to zero, not 0% interest, but like I lost all my money. So negative 100%, if you want to think about it that way. Yeah. So pick your company wisely. So now we're starting to get to the risk area. Do companies go bankrupt often? Not really. I mean, but I took a high risk company there that was swinging. And again, whatever you're comfortable with. I didn't put all my money into that company. I don't want to lose all my money. So anyway, you take a risk. And then it gets riskier as you go to this end of the spectrum, to the right. You got commodities. You could invest in gold, oil, wheat. Again, those things, you could make a fortune or you could lose it, or lose a fortune, right? Then you could go do cybersecurity, Bitcoin, all that stuff. Again, those fluctuate. I mean, sometimes Bitcoin is worth $100,000 for one coin, for one share. Now it's worth 69,000. So see how quickly those things move? I mean, big swings, right? So that's, again, high risk, high reward. Who knows? I mean, maybe you could have sold it at 100,000. Maybe you bought it when it was $3 and now it's 100,000, and you sell it and each coin went up by that much. Each coin that you bought for $3 is now worth 100,000. You had like 10 coins, instant millionaire. So, but at the same time, let's say you put in $10,000 in a Bitcoin and then it went down and now your $10,000 is worth like $50. So again, high risk, high reward. And Vegas, of course, is the ultimate high risk, high reward. You could double your money. You could bet on red or black on the roulette wheel and double your money in a second. You could go from 50,000 to 100,000 in 1 second, right? Or you could go from 50,000 to zero in 1 second. So that's what I mean by being aggressive versus being conservative. So that's the whole spectrum of investment for what you want to know. This is not an all-inclusive list. There's all this other stuff, T-bills, treasury bills, all this stuff. But I want to focus on you know, the commonalities of a savings account that you put towards retirement. I mean, we're not going to get so fine-tuned and crazy here. Just like that mathematical example, we're talking about addition, subtraction, all the useful stuff for the everyday person. We're not going to talk about Boyle's law or, you know, some crazy Brownian motion, or, you know, what a PhD in math is, the 1% think about, right? We're thinking about the easy things that are common, that 99% of the people will use 99% of the time. So and that comes down to this area right here. When we and we'll talk about it. Like I said, this is gonna be, we're gonna talk about it more, but stocks and bonds pretty much is where we're living, where the normal investment, normal regular investor is thinking of. Mutual funds cover every spectrum, and we'll define mutual funds later. And then same thing with IRAs and 401ks, retirement accounts. They also cover the whole spectrum of conservative to aggressive, but mostly bonds and mutual funds is what we're looking at for mutual fund. Bonds and stocks for mutual funds and IRAs. So there's your spectrum of how risky you want to play it. Okay, and I will share with you my thoughts on how risky I played it and where it led me. You already know the one piece about the liver problem stock. And that didn't end out too well. But I only invested, you know, I think I invested $1,000. I mean, it's not much. It wasn't going to kill me. But if it would have succeeded, I probably would have been a rich guy. Okay, very rich guy. All right. Well, when you look at financial and investment avenues, you're going to see a lot of graphs like this. The financial companies, T. Rowe Price, Vanguard, those ones I mentioned, they're going to give you performance graphs of how their mutual funds performed over a span of time. And it's the same thing if you go to a separate company. If you go to Apple, Coca-Cola, Boeing, any of those companies, Exxon, any of those companies, you could look at how well their stock has done through the years, the value of their stock versus the years. And you'll see graphs like this. So that's how you do your research on whether you want to invest in a certain mutual fund or a certain company or a certain bond even, is you look at these graphs and you see like, wow, it goes up. It has been going up these past, 10 years or consistently. So that's how you make decisions on doing it. So since it's important to know how to read a graph, I'm going to go up, and many of you may already know how to read a graph, but let's just go through the basics. I think it's worth it to go through the basics. So on the left here, there's a table of a fictitious stock price, and you can see the two axes, the X and Y axes. We're gonna turn this table into a graph. So you could see the price of this stock. So on the first day of the month, it was worth $10. On the third day of the month, it was $7. Seventh day of the month, it was worth $9, and so on and so forth. So we're gonna graph it, and this is again going down to the basics. Let's do the basic graph. So on the x-axis down here, the horizontal part, are the dates of the month. You can see it goes from 0 to 30. The 0 date of the month to the 30th day of the month. Actually, the first day. So on the first day of the month, that would be about right there. It was worth $10. So first day of the month is here, and then you just go up to where it's $10 right here at this point, and you make a data point right there. So there's one data point. On the third day of the month, so you can see on my scale down here, it's 1 is here, 3 would be about right there. On the third day of the month, it was $7. So if 10 is here, 7 would be about right there. So there's 7. So again, you go, this is 3, and you go up, and you hit the 7 mark. And there is another data point. And you could do the same with the 7th. If you look over here, The 7th of the month is about halfway between 0 and the 15th. So I'll do that. And it's $9. So it's a little bit under the 10, about right there. So again, right here. There's another data point. And then I'll do the last three there. 15th is $14. So 15th and $14 about right here. There's another data point. On the 29th, it was $11. So 29th is right near the 30. So there's 29. And it says was $11. So $11 is a little bit above the 10. So if you do that, there's that data point. And finally, the 30th is $17. So there's a 30th. You go up, and 17 is about right here. And these are just gross estimates. So I plotted my data points, and then with the data points, what they normally do is they just connect them. So they go like that. So here is your graph. So that's how the alpha stock, calling it alpha stock, that's the title of this graph. It did this. So that's the value of your alpha stock through time, from the zero, from this month, from the 1st of the month to the 30th of the month. It did this, and you can see the value went from $10 here, and it ended up at what, 17? Yeah. So it has its ups and downs, right? And if you want to look at it, and another way to look at it is it has ups and downs, but what did it do from this point, from the 1st to the 30th? It basically did this. Like, you could just normalize it and go like that. So you see an upward trend, right, over the long term, or over that term. So that's it. That's how you do a graph. The blue line is the actual what happened, and then you could look at the yellow line here as the average, or the normalized version, I guess, if you want to call it that, to go up. One quick warning with graphs is that you just want to make sure you understand the scales, right? Because you can get thrown off if you don't see what the scale is. So look at this scale. Look at the graph on the left. See how the scale is like stretched out? 0 to 20 is like this big length here. And for the days, day 0 to day 30 is that there. But if you do another graph, another company might graph it differently, where they make it smaller, where it's like a smaller proportion. The proportions are still there, but it's a smaller graph. So it's squeezed in more. So 0 to 30 at the bottom is compacted more, and so the top is too. So if you plot this guy out, if you plot this graph out, so I'm gonna do it real quick. The first was $10, so that's about right here. The third was $7, so 3rd and 7 was down here. The 7th day was $9. 7th day, sorry, let's do that. 7th day is in the middle, because $9 was there. The 15th day was $14, so that's about right here, point. The 29th day was 11, so 29th and 11 is about right there. And the 30th was $17, so about right here. So now let me draw this graph. So this graph comes out like this. So it's kind of the same shape, but the graph on the left looks more dramatic. Sorry about all these scratches, but that graph looks more dramatic than this graph, right? Look at the yellow line. The yellow line did that. The yellow line here does this. Looks like you made more money when they graph it on the left side, but it's the same data. So all I'm saying is, when you look at graphs, you already know how they come out with the points and come out with, the whole picture is 1,000 words thing. Instead of looking at this table here and trying to interpret all the numbers in your head, you could just look at a graph and see how your investment has done over time. But when you do that, All I'm saying is be careful with the scales. Make sure you're looking at the scales, because sometimes you're not comparing apples to apples. You're looking at two graphs, apples to oranges, and you might judge one over the other, but you're not really looking at the scales, and one might be better than the other, depending on how the scales go. So that's it about graphs, and enough about with the chalkboard work. So I hope with this, we just covered graphs, how they graph prices versus how a stock has done throughout the years or days or span of time. Covered that. So hopefully you're more comfortable with graphs now. We covered what shares are. This is the basic building block of investment. So remember, you're buying shares, and your share prices go up and down each day. You're in it for the long run though, so don't be like looking at it every day. And then finally, the conservative and aggressive and all the different types of vehicles that you have, as well as the vehicles up here of financial institutions that you can open up an account with, as well as companies you can open up an account with. I've never went directly to Apple to buy their stock. I've went through one of my accounts here, my Vanguard account. I have a Vanguard account, and I buy stocks. I never bought Apple actually, but anyway, so there it is. That's the end of the video. Really appreciate you guys tuning in and watching. So a lot of those concepts are basic, but there was a lot of them. So it's really important to get an understanding of the foundation, right, of this all. On the next section, on the next video, we will go over a few more definitions that are based upon what we just covered. So we're going to talk about no-load mutual funds, traditional IRAs versus the Roth, the 7-2 rule. We're going to talk about the different types of mutual funds that you could invest in. And then after that, after we build on all the definitions, after we finish all the definitions and cover them, then we're going to go into concepts and the ideas, the stuff that drove me at least. And then you can take those tools and then figure out the best way with your situation. Because again, every person is different. Every situation is different. So if you have not subscribed and liked already, if you could do me a favor and go ahead and do that, that'd be great to support. And looking forward to more videos. And I hope you got something out of this. So take care. Hope you have a great day. And looking forward to making the next video. Take care, everybody. Goodbye.